If you owe the bank $1 million, that is your problem. If you owe the bank $100 million, that is the bank's problem. If you owe the world $38 trillion, then you are the United States. In October 2025, the U.S. national debt broke through $38 trillion. Sounds abstract, right? Let's put it another way. The U.S. government is now adding $70,000 of debt every second. In the 15 seconds you spent reading this sentence, the U.S. just owed another $1 million. Broken down, every American carries a debt burden of $110,000, yet their median annual income is only $40,000. What is even more ridiculous? No one is panicking. Wall Street trades as usual, global central banks line up to buy U.S. Treasuries, and the dollar is used just as it always was. It's like watching a guy drowning in debt, using half his monthly paycheck just to pay interest. Yet the credit card company not only doesn't chase him for money, they actively raise his limit, and neighbors rush to lend him cash. Greece went bankrupt with debt under 130% of GDP. Argentina defaults every few years, but U.S. debt is already 123% of GDP, and interest payments exceed military spending. Yet it keeps borrowing heavily and cheaply. This whole thing just doesn't look right, no matter how you look at it. The answer isn't that the U.S. can perform magic, but that it holds a power no one else has: the ability to define the rules of money itself. The logic we were raised on is, make money first, then spend it. You work to earn $3,000, then you can buy those sneakers. A company needs profit before it can issue bonuses. This logic holds true for you and me, but for the U.S. government, it's a completely different game. In March 2020, when the pandemic hit, the U.S. Congress passed a $2.2 trillion relief bill. Where did the Treasury find that much money? The answer is, they didn't find it anywhere. They typed it out on a keyboard. Congress says it wants to spend $2.2 trillion, and the Treasury directs the Fed to add numbers to bank accounts. Suddenly, you have a $1,200 subsidy in your account, and companies see millions in loans appear on their books. This money didn't exist before, and now it does. It is that simple. So what about national debt? Many people think government bonds are for raising money, but that is the biggest misconception. Bond issuance happens after the government spends the money, not before. The government first creates money to spend, then issues bonds to absorb some of it back, preventing excess cash from causing skyrocketing prices. Treasury bonds are a tool for stability, not a means of financing. It's like you opened a bank. When you need money, you don't need to borrow from anyone, you just write a number in the ledger. The only worry is, if you write too many numbers, the money becomes worthless. From March 2020 to March 2022, the U.S. M2 money supply, that is, the cash circulating in the market, skyrocketed from $16.1 trillion to $21.9 trillion, a 36% increase. In 2 years, $5.8 trillion was conjured out of thin air, equivalent to Japan's entire annual GDP. This money wasn't backed by gold or trade surpluses. It was just typed out on a keyboard. Sounds like a scam, right? But it works because the whole world accepts dollars. And the world accepts dollars not because they trust how reliable the U.S. government is, but because they have no choice. Suppose you are the Saudi oil minister, exporting millions of barrels daily. What currency do you accept? US dollars. Can you accept euros? Theoretically, yes. Practically, no. Why? Because international oil prices are pegged in dollars, the futures market trades in dollars, and buyers are used to paying in dollars. If you ask for euros, buyers have to exchange currency first, raising costs and risks, and your oil won't sell. So you can only accept dollars. Once you have the dollars, what do? Saudi Arabia can't use that many dollars domestically, so they must be invested. Where is the safest place? U.S. Treasury bonds. Thus, petrodollars flow right back to the U.S., a perfect cycle. This isn't just Saudi Arabia's problem. Of the $7.5 trillion in daily global forex transactions, 89.2% involve the dollar. Japan buys iron ore from Brazil, swapping yen for dollars, then to reals. Germany imports parts from China, and the middle step has to go through dollars too. Why? Because the dollar has the best liquidity, global banks all have dollar accounts, and transaction costs are the lowest. This is the lock-in effect. It's not that the dollar is so excellent, but that everyone uses it, so you lose out if you don't. Just like knowing Windows has bugs, but since the whole company uses Windows, and your files, software, and workflows are tied to it, can you switch to Mac? The cost is too high. The dollar is the Windows of the financial world. In the first quarter of 2025, 57.74% of global foreign exchange reserves were still in dollars. Central banks hold dollars not out of love for the U.S., but because doing business, handling crises, and stabilizing exchange rates depend on it. This lock-in gives the U.S. a privilege. It doesn't need anyone's permission to create new dollars, because the world is already locked into this system. As long as the U.S. ensures the system doesn't crash, the lock-in will perpetuate itself. Here comes the question. Since the U.S. can print money to pay debts, why not print tens of trillions to clear it all? The answer is, it is printing. It's just making you quietly foot the bill. Where did that $5.8 trillion in 2020 come from? Created out of thin air. This money entered the market chasing goods, but the amount of goods didn't increase. Factories closed, supply chains broke, and production fell during the pandemic. More money chasing fewer goods inevitably leads to price increases. From 2020 to 2024, cumulative U.S. inflation exceeded 20%. Eggs went from 50 cents to 60, gas from $2 to $3, and rent rose 25%. Your wages might have risen too, but they never catch up to prices. This is the invisible tax. The government doesn't tax you openly. It takes your wealth through currency devaluation. Your account still has $100,000, but it can only buy $80,000 worth of stuff. Where did that $20K go? It was diluted into the monetary system. What's even more cunning is that this dilution is global. The U.S. runs a trade deficit of over $600 billion annually, meaning over $600 billion flow overseas, becoming foreign-held dollar assets. These overseas dollars act like a giant reservoir, helping the U.S. absorb inflation that should have exploded domestically. To use a metaphor, you blast the heater at home. It should be hot, but you open the door to let the heat escape to your neighbor's house. You stay comfortable, but your neighbor starts sweating. The U.S. does just this, exporting inflation pressure to the world. Countries holding dollar reserves are taking the hit for the U.S. How long can this last? As long as the world is willing to hold dollars. But willingness isn't a switch that suddenly flips from yes to no. It's a scale that slides slowly until it hits the danger zone. In fiscal year 2024, the U.S. spent $6.75 trillion, but earned $4.92 trillion, a gap of $1.83 trillion. How to fill it? Issue bonds. Who buys? Domestic banks, insurers, pensions, plus foreign central banks and investors. The problem is, with $38 trillion in debt, the interest alone is an astronomical figure. In fiscal year 2024, interest payments were $1.133 trillion, accounting for 23% of revenue. For every $100 collected, 23 go straight to interest, leaving only 77 to get actual work done. What's scarier is this ratio is soaring. In 2020, interest was only $300 billion. It nearly quadrupled in 4 years. Why? Debt is rising, and rates are rising. 2020's 10-year yield fell to 0.5%. Now it's over 4%. Every 1 percentage point rise in rates costs the U.S. an extra $380 billion in annual interest. It's a death spiral. Debt up arrow, interest up arrow. Deficit up arrow. Borrow more arrow. Debt up again. To break it requires raising taxes or cutting spending, but neither is politically feasible in the U.S. Democrats want to tax, Republicans block it. Republicans want to cut welfare, Democrats oppose it. So the result can only be keep borrowing, keep printing. The CBO predicts total interest payments over the next decade will be $10.6 trillion, with a cumulative deficit of $20.2 trillion. By 2035, half the deficit might come from interest, paying interest on old debt with new debt. A new change appeared in 2025. In the second quarter, foreign official institutions spent only $5.1 billion on U.S. securities, a 94.4% plunge from the previous quarter. This wasn't a one-day anomaly, but a trend spanning 3 whole months. Meanwhile, China and Japan, the 2 largest holders of U.S. debt, reduced their holdings by $112.8 billion in 2024. What does this mean? Overseas buyers are retreating. The U.S. issues trillions in bonds annually. If foreigners don't take them, who will? Domestic institutions. But domestic purchasing power is limited. If demand drops while supply rises, prices fall. A drop in bond prices means yields rise, which means borrowing costs rise, sending interest soaring further. A clearer signal is gold. In 2024, global central banks bought about 1,000 tons of gold, double the past average. Gold's share in central bank reserves surged from 6.4% a decade ago to 30% in 2025, nearly catching up to the 40% of dollar assets. Why are central banks buying gold like crazy? Because gold can't be printed, can't be diluted, and doesn't rely on government credit. What are they saying by buying gold? They are saying, our trust in paper money is falling. There's another rare phenomenon. In April 2025, the U.S. 10-year yield rose to 4.589%, meaning bond prices were falling. Usually, the dollar should rise at this time, as high yields attract capital. But that month, the dollar index fell below 98, hitting a new 3-year low. Both falling simultaneously means what? Investors aren't rebalancing between bonds and dollars. They are dumping both to flee to other assets. Seen individually, these signals can be explained, but appearing together, they point in one direction. Confidence is loosening. The U.S. won't go bankrupt, that is true. It can print money to pay debts, which is also true. But is there no cost? The cost has changed form. Not default, but devaluation. Not refusal to pay, but the money becoming worth less. There is a precise saying, the U.S. won't run out of money, it will run out of tolerance. What tolerance? The market's tolerance for inflation, foreigners' tolerance for dollar depreciation, Americans' tolerance for soaring living costs, and the global tolerance for U.S. debt expansion. This tolerance has a threshold. Exceed it, and the system changes. But the threshold won't flash a red light to warn you. It moves quietly. Imagine a rubber band. At first, stretching it is easy. Continue stretching, and it's okay, just takes a bit of effort. Stretch more, and resistance grows. At the critical point, the band won't snap immediately, but cracks appear. You can't see the cracks with the naked eye, but the structure is changing. Pull a little more, and snap. It breaks. The US monetary system is in this process right now. The rubber band hasn't snapped, but cracks are appearing. What did the cracks look like? The dollar's share of cross-border payments fell from 49.7% in April to 46.9% in August. More countries are bypassing the dollar to trade in local currencies. Central bank gold purchases broke records. US bond yields and the dollar are falling together. Each crack is small and won't trigger a crisis alone, but they are accumulating. When there are enough cracks, system resilience drops. Shocks that were easily weathered before now trigger massive volatility. Problems previously ignored now cause worry. Many are waiting for a Lehman-style collapse, currency going to zero, or bank runs. But what will really happen isn't a crisis, but a repricing. What does that mean? The world starts valuing the dollar at a different price. Before, they thought the dollar was safe and bought at 2% yield. Now they think risk is high and want 4%. In the future, they might want 6% or 8%. This process isn't overnight. It happens gradually. Yields going from 2% to 4% is just a number to you. But to the US government, it means paying hundreds of billions more in interest annually. Where does the money come from? Tax hikes, spending cuts, or borrowing more. Choose borrowing and debt swells. Investors demand higher yields, a vicious cycle. Meanwhile, the dollar's reserve share continues to drop. Not a crash, but dropping a little each year. From 57% to 55% to 52% to 50%. At some point, the dollar ceases to be the dominant currency and becomes just one of the major currencies. This tipping point might be 50% or 45%, but once crossed, psychological effects will amplify. What happens then? The US can still print money, but the printed money loses purchasing power faster. Inflation becomes harder to control. Living costs rise significantly. The middle class finds that even if wages rise, their quality of life drops. Social discontent grows. Politics become more divided. This isn't doomsday, but a major adjustment in living standards. The American model of high consumption and low savings over decades was built on dollar privilege. As privilege shrinks, this model becomes increasingly hard to sustain. Back to the start. Why does the US never run out of money? Because it holds the printing press. It doesn't need to borrow from others to pay debts, it just prints. But the cost of printing is devaluation, a cost borne by all dollar holders, including Americans and including foreigners holding dollar reserves. This is an exquisite wealth transfer mechanism. The government prints money to spend, and the devaluation cost is spread among every currency holder. The number in your account hasn't changed, but your purchasing power is falling. It's not on a tax bill, but it has indeed been taken from your wealth. Even more exquisite is that a significant part of the cost is shifted abroad. Because the global system is locked onto the dollar, foreigners must hold dollar reserves. When the US creates new dollars, this money flows overseas, diluting the value of all dollars, including those held by foreigners. The US is exporting inflation. The system turns because the world has no choice. Switching systems costs too much. But having no choice isn't eternal. When the cost gets high enough, people look for alternatives. Not jumping ship immediately, but hedging, diversifying, and preparing backups. 2025 data shows this process has started. Dollar share down, gold reserves up, local currency settlement up. Each change is small, but the direction is consistent: diversification, decentralization, reducing reliance on the dollar. What does this mean for the average person? If your wealth is all in dollars, you are bearing systemic risk. The US won't default, but your purchasing power is being diluted. This dilution isn't in the future tense, it's in the present continuous tense. 20% diluted from 2020 to 2024, and potentially another 20% to 30% in the next 5 years. System resilience protects the system, not your money. Debt growing at $70,000 per second, annual interest over $1 trillion, total debt at $38 trillion. These numbers are too big. They numb you. But the impact is real, right in your life. Supermarket prices, rent hikes, and that moment your wages can never catch up to costs. The US will never run out of funds, but the value of the dollar is being redefined at the rate of $70,000 per second. If this video made you rethink the nature of money, like it so more people can see it. Share your thoughts in the comments, remember to subscribe, and see you next time.